One quarter. That's all it took. One single quarter for the company that dethroned Tesla to watch more than half its profit disappear. We're talking about BYD, Build Your Dreams, the Chinese electric vehicle giant that every major analyst called unstoppable. The company Warren Buffett bet big on. The brand that in 2024 outsold Tesla globally in total EV deliveries. That BYD. And in the first quarter of 2026, its net profit collapsed by more than 55% compared to the year before. Not a slowdown, not a rough patch, more than half, gone. So how does the most important car company in the world fall this hard, this fast? The answer isn't one disaster, it's 5, and every single one of them is connected. Let's go back to the beginning, because BYD's origin story is unlike anything else in the auto industry. The year is 1995. Wang Chuanfu, a chemist, not a car guy, founds a small battery company in Shenzhen, China. They're making rechargeable batteries for mobile phones. Nobody in the auto world is paying attention. That's exactly how Wang wanted it, because Wang saw something nobody else did. Whoever controlled the battery controlled the future of the car. By 2003, Wang made a move that looked absolutely insane at the time. He bought a failing state-owned car company and decided BYD was going to build automobiles. Everyone called him reckless. But for the next decade, while nobody was watching, BYD quietly stacked up patents, refined its battery chemistry, and developed what would become its most powerful weapon, the Blade battery. A lithium iron phosphate design built to be safer and cheaper than anything else on the market. And here's the one detail that separates BYD from every other EV company on the planet. Tesla buys battery cells from Panasonic and Chat. Ford and GM source from suppliers too. BYD makes its own batteries, its own motors, its own chips, even some of its own semiconductors. That is called vertical integration. And it meant BYD could build an electric vehicle for thousands of dollars less than almost any competitor and still turn a profit. In 2022, BYD made a decision no major automaker had the confidence to make. It stopped building gas-only cars entirely. Every vehicle going forward, electric or plug-in hybrid, period. And the timing lined up perfectly with China's government pouring enormous subsidies into EV adoption. By 2023, BYD had passed Volkswagen to become the best-selling car brand in all of China. Not the best-selling EV, the best-selling car, full stop. Then, in 2024, it outsold Tesla globally in total electric vehicle deliveries. The company that started making phone batteries had just dethroned the most famous electric car maker on Earth. It looked unstoppable. It looked like the future had already arrived, and BYD owned it. But here's the thing about a company that grows this fast, on this many fronts at once. Speed like that doesn't just create winners, it creates cracks. And by the time those cracks started showing, most people weren't looking close enough to see them. The first crack, and the one that started the entire unravelling, was the price war. In May of 2025, BYD announced price cuts of up to 34% across 22 different models. Some cars dropped by the equivalent of $10,000 overnight. On the surface it looked like dominance, BYD flexing its size, daring smaller EV makers to try and keep up. But BYD's own stock fell 8% the very same day, because investors immediately understood what this really meant. It wasn't a power move, it was a fire sale. Here's what was actually happening. BYD had built far more cars than people were actually buying. Industry investigators found that dealerships across China were sitting on more than 3 months of unsold inventory, more than double the healthy industry standard. Picture a lot so packed with unsold vehicles, there is literally nowhere left to park the new shipments arriving from the factory every single week. That is not a success story. That is a company that built its forecasts on hope instead of real demand. The price war that followed didn't just hurt BYD, it torched the entire Chinese auto industry. Researchers calculated that price cuts between 2023 and 2025 destroyed roughly $69 billion in industry revenue. Average vehicle prices across the Chinese market fell more than 11% in just 3 years. Chinese regulators eventually had to step in and explicitly ban automakers from selling cars below cost, a rule they had to write because companies were doing it anyway, just to keep the lights on. And the damage showed up exactly where you'd expect. Net profit down more than 55%, revenue down nearly 12%, and BYD's market share inside China, its home turf, the foundation of its entire empire, dropped from roughly 33% down to 26% in a single year. Here's what makes this even more uncomfortable. A massive chunk of BYD's profit in 2025 was being propped up by government money. Over 12 billion yuan in subsidies, nearly 40% of its entire net profit coming directly from state support. Take that away, and the picture gets a whole lot darker. If you rely on breakdowns like this one to understand what's actually happening in the global auto industry before it hits the mainstream, go ahead and subscribe to AutoKul right now. We cover every major financial story, automotive disaster, and market shift before most channels even start reporting on it. Now let's talk about what was happening on the ground, at the dealerships, because this is where BYD's crisis turned genuinely brutal. In April of 2025, one of BYD's biggest dealer networks in China, Shandong Changqing Holdings, collapsed almost overnight. This was not some small local operation. It was a group running over 20 dealerships, generating roughly 3 billion yuan a year, employing more than 1,200 people. One of its flagship stores had been named the #1 BYD showroom in all of China. Within weeks, more than 20 locations shut down completely. Customers who had prepaid for multi-year service packages, insurance bundles, and maintenance plans showed up to find the doors locked and the lights off. Some employees reportedly went unpaid for up to 6 months. BYD and the dealer network blamed each other publicly. The customers holding worthless contracts didn't care who was right. They just wanted their money back. Investigators found evidence of what's called channel stuffing. BYD pushing dealers to take on far more inventory than they could realistically sell, propping up the company's own reported sales numbers, while quietly shifting all the financial risk downstream. Independent researchers at GMT Research, the firm that helped expose the Evergrande collapse, found BYD's real adjusted debt was closer to 323 billion yuan, more than 10 times the official figure, built by stretching out supplier payments rather than borrowing money directly. And then came the recalls. Between late 2024 and late 2025, BYD issued recall after recall. Nearly 97,000 Dolphin and Yuan Plus EVs recalled over a steering defect with fire risk. 7,000 Fang Chengbao SUVs, again fire risk. Then, in October 2025, the largest wave, over 115,000 vehicles pulled back for a drive motor controller that could fry its own circuit board, and battery packs sealed so poorly that water could infiltrate from the outside. Weeks after that, nearly 89,000 Kin Plus hybrids recalled for a battery defect that could cause sudden, unpredictable power loss while driving. Over 300,000 vehicles recalled in barely 12 months. That is not a few rough edges. That is a pattern. Owner complaints spread fast across social media. Videos showed door panels and fenders flexing under light hand pressure. A crash beam on a $42,000 model visibly bending by hand. Rust forming on a 2-year-old vehicle. For a company that built its entire reputation on engineering precision and vertical integration, this was hard evidence that corners were being cut to hit aggressive price targets. Now, why have you never seen a BYD on an American road? And why does that actually reveal something bigger about BYD's global problem? The United States applies a 100% tariff on Chinese-made electric vehicles. BYD isn't losing market share in America. It was never allowed to compete here at all. So BYD chased growth everywhere else. Europe, Brazil, Thailand, Turkey, Indonesia, building local factories to sidestep tariffs, raising its 2026 overseas delivery target to 1.5 million vehicles. But even that route came with thorns. The European Union added a 17.4% duty on top of existing tariffs. Brazil raised its own barriers. When Chinese exports more than doubled in a single month in early 2026, other markets began building the same defensive walls. Local factories help long-term, but they take years to ramp up. Right now, BYD is locked out of its single biggest potential market, facing rising trade barriers in its next best options and drowning in unsold inventory back home with nowhere to send it. So here is the honest buyer advice. because that is what this channel is actually about. If you're outside the United States and BYD is available in your market, do not rush. The massive price cuts that already happened mean buyers from 12 months ago took an immediate resale value hit. If you're in a country with an established BYD dealer network and strong service infrastructure, the value case still exists. But before you sign anything, especially a prepaid maintenance plan or multi-year service bundle, verify independently that your local dealer group is financially stable. The collapse of dealer networks like Shandong Changqing is a real-world warning about what happens when a company expands faster than its support structure can hold up. If you're in the US, BYD simply is not a realistic option under current trade policy. There is no credible near-term timeline where that changes. Here is the final truth this entire story keeps coming back to. BYD's individual failures, the price war, the recalls, the dealer collapses, the hidden debt, none of them happened in isolation. They were all symptoms of the exact same root cause. A company that scaled faster than its quality control, faster than its dealer network, faster than its supply chain, and faster than actual global demand could keep pace with. BYD did not build its empire on patience. It built it on speed, government subsidies, and a pricing strategy that eventually consumed the very company that launched it. This does not mean BYD disappears tomorrow. It is still enormous, still expanding into new markets every quarter. But the era where every headline was another record broken, where every analyst was calling it the most important car company in the world, that era is over. What replaced it is a company fighting fires on every single front at once, trying to prove that the empire it built at record speed was not standing on a foundation already starting to crack. In the auto industry, speed without discipline always catches up eventually, no matter how big the company, no matter how cheap the car. If this breakdown helped you understand what is actually happening inside the global EV market, hit that like button and subscribe to AutoKul for more. BYD is far from the last domino to fall. When the next one drops, we will be right here to break it all down for you.